On today's show, 3 questions. Number 1, what is the most exciting day in December? Number 2, is Jim Carrey broke? And number 3, are we in for another big market return in 2025? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
I am Jake.
And I'm Rabih.
A little delayed there, Jake. Has it been a while?
It's been a couple of weeks, yeah. We're just getting warmed up.
It's the end of the year. That's what it is. We're all kind of like checked out. We have like senioritis of 2024. So this is not going to be our last show of the year. This is going to be our Christmas special, right? This is coming out right before Christmas. And
it's coming up tomorrow.
Yeah, it's coming out tomorrow. So right before Christmas. Christmas is next week.
Oh, yeah, true.
I was trying to keep track because we're doing 3 shows today. Or no, I guess 2 shows today. And I'm trying to line up which show's coming out when. So this will be our Christmas special, Christmas next week. And speaking of that, Rabih, we're talking about the most exciting day of December.
Yes.
You're saying, and you immediately said, not Christmas. So tell us more about this.
No, of course it's not Christmas. Guys, I've been telling you for the last month that the market's checked off. Everyone is on vacation. Nothing matters except one day this year. And it's this month. And it's when the Federal Reserve is going to meet in December. Right? Well, we got all a slap on the face because the Federal Reserve came out, cut interest rates by a 0.25 percentage point, which was expected for December, all was priced in. However, flipped the narrative on the expected path of interest rates for 2025. The market did not like it. We got a decent one-day correction, I would call it. Only one day. And we got a lot from the Federal Reserve that we will be able to talk about today. So are you guys ready?
Ready.
All right.
I don't know why JPL's got to be flip-flopping on us like this, but whatever.
All right. And he didn't really flip-flop, but he's saying like the economy is strong. We don't need to cut interest rates as much as we think we need. And the market didn't like it. And the market did not like it. So before I delve into the numbers, I'll just tell you what the market reaction was that day. The Dow Jones dropped 1,123 points, or like 2.58%. The S&P 500 dropped 2.95%. NASDAQ dropped 5.6%. And the Russell 2000, which is small cap, dropped 4.06%. And the VIX volatility index increased from like around 13, 14 level all the way to 27, a 76.18% appreciation in one day, which is its second largest since, I don't know if you guys remember, in 2018 when the VIX suddenly spiked and a bunch of leveraged ETFs and like products just went bankrupt and the market freaked out for a couple of days. This was the second largest simply because the VIX is starting from a very low position. So the market kind of had a reality shock. It dropped back down to fundamentals. Some companies actually took a hit. Like we're talking about Tesla, which was up around 60% since the elections, kind of corrected because there's been a lot of upward momentum since election with no news or no new earnings coming in. The market was getting ahead of itself, very euphoric, and that one set the expectations. It's a healthy incorporation of appropriate information into the prices, although it comes with pain. So whoever was looking at their brokerage account on that day, and I hope you weren't, it wasn't nice. It was a bad day. So let's talk what caused it. And to get into that, we're going to discuss the summary of economic projections. Those are the numbers that are issued by the Federal Reserve every single quarter, and they tell us what their expectations about the path of the economic growth, unemployment, inflation, and interest rate is going to be going forward. So let's start with GDP. So in September, their projections for the growth in the economy, real GDP, was 2%, but we've got in really good numbers in Q1, Q2, and Q3 that now the projection is that the economy this year is going to be growing at 2.5% annualized instead of the 2% that they had in mind for the whole year. So imagine your economy is growing 25% more than what you've been expecting for the whole year. That is huge, right?
Huge, yeah.
That is the first thing. The second is unemployment rate. they had unemployment rate at 4.2%, and then we kind of saw the labor market slipping out of balance a little bit. It increased to 4.4%, and in September they were like, you know what, we'll just follow the market, we'll set it at 4.4. Well, that slip off was temporary. The labor market was back in balance, so they switched back to 4.2. So they are there. It's this range between 4.4 4.2. This is the current level of unemployment, and this is what they expect it to be for this year.
For now, till the next meeting.
Yes, and they expect it to be, actually, they did not change this up till 2027. They do not think unemployment is going to budge up or down from now till 2027, which is a wild claim. We'll see how that pans out. Maybe not for the next year, but you're extending. When they mean that it's not going to change for 2027, they mean that the new equilibrium for labor market is now 4.3%. We had a really good stretch where it was 3.7, 3.5 for a couple of years. And they're saying now we're in a different state of an economy where the equilibrium rate in the labor market is at a higher and elevated level of 4.2%. As long as this doesn't create like pressure on the GDP, that's fine, because they said GDP is going to be growing at 2.5 this year, 2.1 next year, 2 the year after, and 1.9 in 2027, according to their expectations. In a sense, they're saying this current level of unemployment is not actually going to slow down the economy. The economy is going to still be at its 2% target.
Rabih, did they allude to like a reasoning for their adjustment upward, like up on the equilibrium?
Not much, but the theory is that every single economy, due to its level of innovation and growth and the level of population growth and labor supply that is in the economy, exhibits, they call them neutral rates, which are a neutral rate for the unemployment. What would be a stable unemployment level, and what would be a stable interest rate level, and what would be, the stable growth level, which is the 2% target. So every time an economy goes through cycles, whether there's an episode of inflation or an episode of a recession where they require to stimulate the economy finds a new saddle point, in a sense, to consider it its new equilibrium. And what they are saying that we moved from an economy where the equilibrium rate was around 0%, in a sense. This is what we had for a decade after the 08-09. And we moved from a position where that saddle point equilibrium was at 3.5% in unemployment. And now we move to a place where interest rates might be at 3% as an equilibrium level, and unemployment at 4.2 as an equilibrium level, which are correlated with higher economic growth. So we're saying the economy is going to be at 2.1, 2.2 for a while, not 1.7 and 1.8% growth in GDP. And this new growth regime comes with it two different equilibrium levels that are neutral. And this is what they're saying. And in a sense, we're just in a different economic environment where the equilibriums are different. But we're not too far away where like the economy is going far. We're just in a more optimized state. With that comes their expectations for their PCE inflation. They're also kind of flat. So September was 2.3. For this year, it's up to 2.4. Actually, in 2025, they said their projections are going to be 2.1 for the PCE inflation, but now in December, they adjusted that next year it's going to be at 2.5. So they're expecting this soft landing to take longer and inflation to be, it's not high, but it's going to be taking longer to bring it down to 2%. And because of that, they are changing the path of interest rate cuts. And I think this is the most important part. September, they said that we're going to end the year at 4.4, which is true. We are at 4.4 right now. But what they said is that by 2025, they expect interest rates to be all the way down to 3.4, which means it's a full 1% cut throughout 2025, which the market has been pricing in as a 0.25% cut every couple of months, maybe every 2 months. Now, they said that they expect by 2025, the interest rate to be at 3.9, which means instead of a one full 1% cut, we're going to only have 0.5% throughout the whole year. And, 0.5% affects financial assets across the board. And that was the main reason why equities slashed. There was, some exuberance that they needed to come back to reality, but they also had to reflect this new piece of information that interest rates are going to be 50 basis points higher than what they thought for a full year of earnings, and that will drop prices by 1% or 2%. And this is wild, because this kind of means, and if you look at the federal funds rate futures, it seems like there's going to be nothing for the next 6 months, which are 4 meetings, January, and then I think March, and then April, May. There's not going to be any cuts. And only in June is when we're going to see the Federal Reserve cut interest rates again. And they're only going to be cutting it by 25 basis points.
Kind of like in a wait and see mode for the next 6 months.
They switched after, is this the third? This is the third cut, and a 1% drop. So in September, in October, we had a 50 basis point cut. And then November, we had a 25. And now in December, we had a 25. That's a 1% cut. And instead of them continuing all the way down to the 3.3 level that they've been communicating, they said, oh no, we're going to pause. And we're only going to be cutting another 50, which is half the amount of cuts they did this year, all across 2025. And then we'll figure it out later in previous years. This wait and see mode, because they think the economy is growing really healthy and that unemployment and inflation have reached an equilibrium position where now the economy doesn't need to be tweaked and recalibrated from side to side, according to their words. They think they should just wait and see. And now what would be driving the growth in financial assets, such as stocks, would be actual earnings and actual American spending, rather than them being elevated higher. Just the fact that the monetary system is going to be dropping interest rates to elevate those prices. So it's a healthier system. It's a healthier market if you think of it. But now the whole idea is the Fed is saying we're in a really good position. I'm going to wait and see. And I'm going to be cutting in 6 months.
Yeah, which I think is fine. I think it's fine to slow down. What I find interesting is this idea that they well, I guess for lack of a better term, or the third term that comes to mind is this idea of like false precision. They're getting so precise, and I wonder. I'm guessing the origins of this would be the market kind of demands it. Like the market kind of demands, or I guess I'll ask this, Rabih and Jake. Do you think they're trying to be so precise? So what I mean by that is saying, by next fall, we're going to be down to this percent. And then oh, you know what? Actually, it's going to be 3.9% by next fall. What if they just came out and said, listen, we're going to pump the brakes a little bit. We don't know where this is going to be next year, but we're going to just pump the brakes, wait and see. We don't know where this is going to be. Because that's the truth, right? That is the absolute
That's what
truth.
they're actually saying.
That's what they're actually saying.
They
so what is
mean
this?
that, yeah.
But why do they feel the need to say? Because I think what happens is they anchor people to a certain number, which is why the market sold off, right, Rabih? That's what we're saying is they anchored everyone to this. What was it? You said 3.5 by next year.
Yeah, 3.5 by next year.
3.5, and then they were like, yeah, never mind, it's 3.9. It's going to end up being something probably different than both of those numbers, and they know that. We all, I think, know that. But because they anchor us with this false precision, and then they make this adjustment, the market reacts. I guess my main question is, what do you think that is? Why do they feel the need to throw out specific numbers? Is it because we demand it?
It goes into the models. So yeah, if they don't say a number out loud, I bet you all these reporters in the press conference will be like, so what would it be? How many cuts would that infer to? So in a sense, I don't think they're saying, oh, it should be 3.9. They're saying we might only need to cut twice instead of 4 times. So this puts us at 3.9. So they're getting to that number at the end.
Got it.
Let me make this a little bit spicy. So there were a lot of analysts talking about what does this mean, and there are two theories. There's one theory that says, well, and kind of what I alluded to, there is stability, there's this equilibrium. Commodity prices have been in check, didn't really move for the year. Labor market is in check. Inflation is in check, especially that inflation, according to Jerome Powell, we've been going flat over the 12-month number. So they're looking at, for example, November 2024, comparing it to November 2023, and they're seeing that we're going flat. It was 2.7%. We looked at it in previous episodes, right? And they're looking at those 12-month apart data points and saying we're going kind of flat on them. So we don't want to continue dropping interest rates. We want to keep it a little bit more restrictive by this wait and hold period, in a sense, in the hope that inflation goes down. So if the labor market is staying put, inflation is staying put, commodity pricing is staying put, why wouldn't interest rates stay put? That is the first argument. The second argument gets a little bit more political. They think that
What?
with the
That
new
doesn't seem. That doesn't.
yeah. The second hypothesis, and we don't know, we'll see how it pans out. The second hypothesis states that they think the new administration is going to be inflationary, whether it was by adding tariffs or deporting people or cutting taxes. All of these are inflationary, by the way, or suspending the debt ceiling, which is something we've been hearing about in the last 24 hours. All of these stuff are going to be inflationary in a sense. In an anticipatory move, if you drop interest rates right now, which is an inflationary action, added to it the impact of the policy that is coming out of the administration, inflation might start ticking up again. And they would want to avoid that. They would want to balance out any inflationary pressure coming from the administration. So in that sense, they would be wanting to wait. And in this sense, they kind of cancel each other out. They're not increasing interest rates. This is out. It's not on the table at all. So by them choosing to wait rather than to cut, they are giving themselves some cushioning against any inflationary pressure that might come from the administration. The actual articles were much more opinionated, but I'm trying to give you an objective sense.
I think it's good. I think inflation's a real concern. And again, I think it's good to say, hey, we have a new presidential administration coming in. Let's wait and see how some of this stuff pans out before decreasing rates and getting into a crazy inflation situation again. So I think that's fine. I have another thought too with this that I just wanted to bring up that as you were talking, Rabih, which is I've talked to so many people over the past year really who are getting into real estate deals, whether it's like a practice building or mortgages or getting into different types of loans. And the general consensus has been, well, I'm going to get into kind of a high rate now. And it's okay because in a year from now, rates are going to be way lower than they are now. That's just a consensus pretty much among everyone. It seems like, rates are going to go down. I think this is a good reminder that the powers that be, the Federal Reserve and things can change their mind on a whim. And we actually don't know moving into the future how these things are going to change. And so, like you said, Rabih, they don't plan on dropping rates for at least another 6 months is the current plan. Could be even longer than that. Again, and then the drop may not be as big as we think it is. And so this is just a good reminder for me that we can't predict this stuff. And so if you're making decisions on whether it's a house or a practice building or taking on any other type of loan,
Jake is trying to buy a car.
Yeah, exactly. Yeah. I just we don't know, going in and saying, oh, rates are going to drop. I'm getting in a 6.5% loan right now, but don't worry, it's going to be 5% next year. That's just a dangerous game to play because we truly don't know when these things can change all the time.
That's a great point, Jake. And the nuance here that we've said this before, but just to throw it out there again, the rate that the Fed is talking about and controlling is not the same rate that is tied to mortgages, car loans, all this stuff. So that's one thing we need to reiterate. Now there's a ripple effect, of course.
Trickle down.
Trickle down and the ripple effect, no question. But it's not lockstep. It's not like people were actually confused. I got a couple emails on this and some calls. The second the Fed started this downward cycle of reducing rates, mortgages went up. If you guys remember, they ticked up. Actually, we hit an all-time high, or not all-time high. We hit a 5-year high or whatever. And I had a lot of questions what the heck? The Fed just announced they're dropping rates, and I'm like, mortgages are not tied to the Fed funds rate. It's a short end of the curve. Mortgages are tied to the 10-year Treasury. That's more supply and demand. It's not the same thing. So, Jake, to your point, just to reiterate that, not only can the Fed change, can market dynamics change, and it completely flips from meeting to meeting, but also it's not a direct correlation or direct connection there. So to predict these things is like saying where the market's going to go next month. We have no clue. We have no idea. So also, Rabih, anything else you want to add to that?
One last point, because you hit the nail on the coffin exactly. The Federal Reserve did cut interest rates and they dropped by 25%, 25 basis points. The 10-year Treasury spiked up above 4.5% for the first time in a couple of months. I would probably say 9 months, which is a very high level for the 10-year Treasury. And that is telling you and indicating that market participants are expecting either more growth or more inflation, because you can't really identify which one of these is moving the 10-year trade. And with that, we call the end of the longest yield curve inversion in the history of the US at like 760 days, in a sense, where now the
officially
yield
over.
curve, yes, has uninverted. Uninverted on the spread between the 10-year and the 2-year a couple of months ago, but now it uninverted between the spread of the 10-year and the 3-month, which is more important. This puts us in a position where the banking sector is supposed to be lending the traditional way right now. So they're going to be there's not going to be as much pressure on the financial system as there were when the yield curve was inverted. This will have repercussions. We'll see them as they pan out in the market, but the yield curve has finally ended.
It's interesting. Yeah. I mean, that's a whole other discussion, right? About the yield curve inversion being an indicator in a lot of times historically of a recession. We didn't see that.
We got
Right.
it pretty good. I think people forget about 2022. I think we have such short-term memories. Now, 2022 was kind of
A rough year.
that was a pretty big down year. I know it's like 2023 has been awesome and 2024 was great, but anyway, I feel like we had a semi-decent. I mean, like in the stock market recession, 2022 wasn't great. Well, our S&P was down 18, 19%.
We're gonna hit that.
Anyway.
I'm gonna give some historical numbers on that.
Okay.
Let me hit my topic. I like that. Okay, that was awesome, Rabih, as always. Jake, this is gonna hit me in my heart a little because I grew up. My childhood consisted of Jim Carrey. Still to this day, I fully admit it. Don't at me, as the kids say. Do the kids even say that anymore? I don't even know.
I don't know.
But
you're asking the wrong group.
Dumb and Dumber to me is one of the greatest films of all time.
Okay, well, I was going to ask this. Yeah, we're going from interest rates to talking Jim Carrey. I wanted to start by saying, do you have a favorite Jim Carrey movie?
Dumb and Dumber, not even close for me. It is just a childhood classic of mine.
It's so
I think it's just so good. It's just so good.
I do like the Truman Show.
Truman Show's great. Shout out Ryan for his Truman Show tattoo. I think he's made a lot of good ones. He's made a lot of bad ones, but he's made a lot of good ones. Him and Jeff Daniels, that dynamic, they played those characters so well to me. You think, is your Truman Show for you, Jake?
I was going back, so I'm looking at a list right now. Like, what is my favorite Jim Carrey movie? I think that it is Dumb and Dumber. I mean, my wife quotes Dumb and Dumber again to this day, like on a monthly basis. You know, just different Dumb and Dumber quotes. It is a classic. It's amazing. Truman Show is probably my favorite, like serious-ish movie of his. You know, non-comedy. I like Bruce Almighty. Ace Ventura is still good.
Ace Ventura's classic. What's the unique one of his that I actually thought was pretty underrated, and I actually enjoyed it? Very different psychological. The Spotless Mind one. What's it called?
It's Eternal Sunshine of the Spotless Mind.
Yeah,
right?
That was a very interesting movie, very different. If you talk about the eclectic nature of his movies, Dumb and Dumber versus that, but I actually thought that was a good one.
It's a good one too. Yeah, he's had a ton. Anyway,
Cable
Jim Carrey's
Guy,
amazing.
Cable Guy.
I actually wanted to talk about Cable Guy. So here's the deal. Jim Carrey.
So tell us, is he broke? This is the question. Is
he
broke?
Is he broke? So just for some backstory, he's a very successful actor and entertainer. Did you know that he was actually the first actor to make $20 million for a movie, and it was for Cable Guy?
Wow.
He was the first actor ever to make $20 million for a movie. So his run in the 90s is insane. Like if you look at his 90s, it's crazy. He was estimated a couple of years ago to have a net worth of about $180 to $200 million. Wow. That was his total net worth. So again, he's been very successful. He hasn't really done movies. So he was making movies up until 2016. And then since 2016, he's just done these Sonic the Hedgehog movies, right? Over the past couple of years. He kind of said he was going to retire. Actually, in 2022, he told the media that, hey, I think I'm going to step back from acting. I'm going to be done. I want to spend more time with my family. Just be done with this. Well, as it turns out, he wasn't done. He has kind of unretired here. He did make Sonic the Hedgehog 3. I don't know if there's any Sonic the Hedgehog fans out here listening to this. Those movies have to be terrible. I'm sorry. If you have kids, anyway, he's making these Sonic movies. He said he was retiring in 2022. Apparently he's not. He said he's unretired. So in this press tour for this movie, a lot of people were asking like, hey, like Jim, I mean, why did you say you're retiring and now you're doing this movie? What's the deal here? And his quote is this. He said, I bought a lot of stuff and I need the money. That was his quote for why he did this Sonic the Hedgehog 3 movie.
He bought a lot of stuff. He bought a lot of stuff.
A lot of stuff. You go from $180 to $200 million net worth to now I need the money from these Sonic movies. Again, who knows exactly what's going on here. Morningstar was reported that he placed his Los Angeles mansion up for sale in 2023 and it still hasn't sold yet. So he's trying to sell a house. He says he's doing the Sonic movie to make more money. It seems kind of crazy that someone as successful as Jim Carrey, who's had as long of career as he's had, that you would need money at this point in your life. I mean, that seems a bit wild to have that happen. And so I just wanted to get into a discussion about this, of the differences between how much you make and how much you spend and how that plays into your overall retirement. It seems pretty crazy that someone as successful as Jim Carrey would need to actually make more money at this point in their career. I mean, if you talk about, if you're making $20 million a movie, 1990s, just invest that money in a fairly safe, conservative way, and it feels like you should be just fine, right?
Yeah.
At this point in your life. Anyway, so I wanted to hit on this, and then I want to get your guys' thoughts about this. So I wanted to talk about spending and the importance of spending when it comes to your overall retirement plan. This is probably a bit of a downer topic for Christmas time. I know
Especially
Christmas.
this time of year.
Hey, Merry Christmas. We're going to talk about, please do not spend your money. No, gifts are good.
I'm literally going this weekend to finish up my shopping for my kids. So please, I actually need to hear this.
Okay, well, this isn't meant to be a downer. Again, balance with all things. But anyway, okay, so in the broadest sense, when you're looking about how much money do I need to retire, it is all based on your lifestyle or how much you spend. I think some people think, oh, maybe it's based on my income. No, it's just how much money do you need to replace your current lifestyle? So spending is a huge factor in this, right? So we always like to...
It's everything. It's
everything, really. Yeah, it is not a huge factor. It's everything. So our general rule of thumb that we like to use is you probably need, if you're like looking, how much money do I need to retire? You probably need about anywhere from 25 to 30 times your annual spending is a good, just back of the napkin benchmark for yourself, right? So let's say let's use an example here. Let's say you spend $100,000 a year. $100,000 a year. You probably need around $3 million, right, in total net worth to replace that income. So this is interesting. So then we could talk about, okay, well, how much do spending jumps or decreases impact this number, right? The reason why spending is so important or so crucial to lock in on is every little increase in spending negatively impacts your finances twofold, right? The first is the more you spend, the less you actually have left over to save, right? So if you spend more money, I have less money to actually save for retirement or future goals or anything like that. It also increases the amount that you have to save, which is the killer there, right? So let's talk about this. Let's say you spend, from 1 year to the next, you spend an extra $1,000 a month. That feels pretty easily. Like a lot of us can increase our spending by $1,000 a month. Feels pretty easy to do these days. If you increase your spending by $1,000 a month, that means you need an extra $360,000 in retirement. If you spend just by $1,000 a month, that equates to $360,000 extra dollars you have to spend. If you spend an extra $3,000 a month, so every $3,000 increase in spending per month increases the amount you need to retire by $1 million. It's kind of,
isn't that wild? That is crazy when you put it in that context. Yeah.
Anyway, so the bottom line here is just spending is really important, and keeping a hold on it is, I think we all know this, that is really important. I don't know, I'm probably preaching to the choir here, but this is just a good reminder for people of, we are not like, hey, eat top ramen every single night, don't spend any money. That's not our stance here. But it is important just to keep in mind every increase in spending really impacts how much you need to save and how much you need for retirement. It's a big deal. Even people like Jim Carrey, who have made millions upon millions of dollars over their career, they could end up in a situation where if you're spending enough money, if you're buying enough crazy stuff, where you could be like Jim Carrey, who's like, I actually don't have enough. I'm going to go do a third Sonic the Hedgehog movie because I have all of these expenses that I need to plan for. Anyway, I'm rambling here. Thoughts about that, you guys?
Rabih, you want to go?
No, I like it. I'm just thinking of stuck in the back of my mind. Like, people really try to optimize to getting the highest return they can get on their portfolio, where like, if you try to optimize your living, I'm not saying decrease the standard of living and the quality of life and like the activities that you do, but try to optimize it, as in, I'm not going to say like buy in bulk, but I did this with myself. I bought a season pass for skiing, and I'm trying to go so many times, which is extra fun, just to drop the price per visit for me. Like, if you just try to give the same intentionality that you give to trying to achieve higher return on your portfolio as you do to reducing your spending, or in a sense, optimizing your spending without changing your lifestyle as much, that goes so far.
Huge. I'm going to piggyback off that real quick, Matt, because I think that's
an
amazing point. I mean, the entirety of Wall Street and professional money managers are working 24/7 every single day of the year to try and like earn an extra 100th of a basis point, right? Like really trying to like maximize returns as much as possible. When for most people, there is probably full percentage points of just lifestyle inflation or bloat that you can get rid of for far easier and have a much bigger impact on your future finances than trying to get like an extra 0.1%, right, on your investment returns. It is wild.
I love this discussion, and I love that you put it in that context, Jake, because it does lead to that thinking of when you put it in the context of like $1,000 a month is an extra $300,000+ in required investment. It leads to that thinking is what Rabih just hit on, is like, man, I'm thinking about optimizing. If I want to optimize anything, it's going to be my spending. I think here's the we're going to be downers, guys. Jake, you got us down this path. But here's the truth of it. People don't want to hear the simple truth because it means looking in the mirror. Like they don't want the actual, they don't want like the truth of it, which is what's going to make a bigger impact. A bigger impact is looking in the mirror and saying, what can I do to, like, let's put this again, and obviously in context of a dentist, because we talk about this a ton, which is, hey, if you're going to optimize anything, have it be your P&L at your office. Start looking at that. How do you grow your business? How do you get really into your numbers and get organized? Same thing on the personal side. Before you start looking at, should I be allocating towards this sector or timing, or what private investment should I buy? It's like, do you even know what you spend? Like, those are the simple truths that are going to lead to a higher likelihood of success in the long run. But again, and I'm saying this for myself as well, guys, we're all in this together. It's hard. It's hard to know the simple, or to like embrace the simple truth of success, because it does require you to look in the mirror, and nobody wants that. Everyone wants the magic pill. They don't want to say, I got to just go to the gym and start eating better. That's the truth. But we're looking for the pill. And it's the same thing here.
It can happen to anybody, right? If it can happen to Jim Carrey, it can definitely happen to us, right? And we talk with plenty of dentists who do this too, where they're making great income. But if you're spending all of that income and you're not able to save too much, I mean, you actually put you in a pretty tough position. And so, we always like to say the person who learns to live with less is actually richer than the person who needs a little bit more, right? It's all this is just a math equation, right? Type of thing.
Well, and the difference between being rich and being wealthy, right? You can be a broke rich person. Like you can have a high, we've seen this in dentistry all the time. A high income does not make you wealthy, like at all. I've seen a ton of high incomes where they're living paycheck to paycheck. They're broke.
Wealth is what you don't spend. I think Morgan Housel said that. That's the definition. It's what you don't spend. So anyway, yeah, not to be a downer, please buy your kids Christmas gifts. I think that's a good use of your money. But going into 2025 here, as you're going through your budgets and whatnot, it is extremely valuable to know what you spend, to know where your money's going, making sure you're optimizing for that too. Like maybe you're like, hey, we're spending an extra couple grand a month on things that you don't really like. Maybe it's just stuff. It's like, oh, I would cut this out and my life would be actually a little bit better. Maybe I can spend more on some of the things that I do like. And so anyway, we're not. Yeah.
Oh, go ahead, Jake.
No, I just say like, we're not huge, like, again, eat top ramen, never go out to dinner. Like, that's not what we're trying to say here at all. It's mainly just know your spending, be intentional about your spending, and realize how much it does impact what you're going to need in retirement.
Yeah, I love that. And I think what we're saying here is that there's, and I fully believe this when it comes to money and life in general, that there are no solutions. There are only trade-offs. So it's just be aware of the trade-offs that you're making. And to your point, Jake, I actually want people to spend their money and enjoy it now. It's not, let's squirrel away every dime we have to have a one-day good life. And it's like, no, have the good life now. Just be realistic about what it means when you tell me, I want to retire when I'm 45 and you're spending $300,000 a year. So you're going to need a ton of money to make this happen. So let's just be realistic about these trade-offs. How about we extend that out to 65? Live your good life now. It's going to give you 20 more years to save and get to that point. Again, it's just understanding those things. And then shout out Daniel Crosby. We talk about him all the time. To give you a reference point of what we say, not all spending is created equal, right? Studies will show this time and time again. And I think we've all experienced this here, which is, where do I spend my money to maximize the value in my life or the happiness in my life? It's really three simple areas: experiences, travel, create novelty in your life, almost across the board. That's going to be something that will always have a high level of like return on life. Outsourcing things you don't want to do. I hate folding laundry. I would love to just have someone do that, whether it's cleaning your house or whatever it is. Outsource. And then number 3 is other people. Spend money on other people, charities, people in your life, whatever. Those are the 3 areas that you should be focused on. Try to cut out everything else. Rabih, any final words on this?
I love it.
Perfect. Jake, any other final thoughts?
No, thank you, Jim Carrey, for the movies and for the finance lesson.
Yes, exactly.
We appreciate you.
We do appreciate you on so many levels. Liar, liar. Another great one, by the way.
Oh, yeah. It's a great
classic. So many quotable lines from that one. Okay, last thing. Are we in for another big market in 2025? So I had a friend share this with me. an article out of Yahoo that here's the title of it. The S&P is poised to do something that has only happened 8 times in the last 74 years. Could signal a big move in the stock market in 2025. I kind of already told you guys this, and Rabih, I know you already like eat, sleep, and breathe this thing, so you already knew this. But to share what has happened for assuming, I mean, it's going to be the case. Rabih, where are we for the S&P for the year, roughly?
26.84% year to date.
26, yeah, okay. So 26%. Last year, 2023, S&P did 24%. So this is first time since 1998 that we've seen back-to-back 20+% years in the market. Again, has only happened 8 times since 1950. And so that to me alone was an interesting stat of just like, holy cow, this doesn't happen too often that we see this back-to-back 20% gains. To give some context, Jake, you alluded to this earlier, the last time or kind of when this bull market started, 2022, we had a rough year, down, I think it was 19%, Rabih. So this bull market started in October of 2022. Just to give some context here, and then I want to hear your guys' thoughts. The average bull market lasts about 5 years or 1,866 days. The bottom usually lasts about 2 years. So this is suggesting we're in this bull market since 2022. There's still room to run in regards to just historical context. So since the bottom in October of 2022, and we started this new bull market, the S&P is up around 68% total. The average bull market, do you know off the top of your head, Rabih, what it is? The average bull market over that 5 year or over the 5 year average, 180%.
Okay.
180% total. So again, this is showing like there's more room to run. And then here's the key point where we're talking about like, okay, what historically do we see after back-to-back 20% plus years? The average return in year 3 is 12%, positive 12%, which shows that, again, more room to run. Everyone dump all of your money in to the market because it's only going. No, I'm just kidding. Just wanted to give some context there. Do you guys have any thoughts on this?
I think I saw from Ben Carlson, I may be slightly off on this, but I'm pretty sure that you said, how many times have we had back-to-back years of 20+%? I think we've only ever had 3 years in a row, so a three-peat of 20+% returns 3 times. I think it's 2 or 3 times.
Let's do it, guys.
So maybe we can hit on that there. I like the point that you made, Matt, of there may be a tendency to be like, hey, we've had 2023 was awesome. 2024 was awesome. Should we get out? 2020, how long can we keep this up? And I like the stat that you shared, which is that actually following 20% years in the market, the following year is about, I think it's like a 10-ish% average.
Yeah, it's 12.
In all.
12.
Yeah, 12, which is about average, right? It's kind of funny. Like it actually doesn't signal just because we've been up this. Like there's no difference because we had an up year that we have to have a down year the next one. Not how the market works. Anyway, yeah, it's pretty cool.
What is more likely, a Kansas City Chiefs three-peat or a three-peat of 20% gains in the market?
I actually say the market. I would go the market.
I think so too.
Maybe that says more about Kansas City than the stock market.
I think it says more about the Philadelphia Eagles. Go Birds.
Or the Eagles. There we go. I'm curious what you think, Rabih. If we had to talking about sports, like put odds on this, like we're percentages next year. If you had to guess, let's have some fun of what we think the market's going to do next year.
Make a precise prediction, please.
I want to say, what are your odds of, what would you say, like, what are the odds we have a down year, right? We have a negative return compared to a 20+% return. What do you think is more likely?
Yeah, without conditioning on anything, the probability that the equity markets beat cash is 70% in a given year. The probability that equity markets, given that you had 2 years of growth of 20 plus, is also 70%. And what this mathematically means that they are independent. The fact that we had 2 years of really good growth does not mean anything about the third year. And I kind of disagree with that thinking that we are trying to look at what the market did and try to extrapolate into the future, because the market and its position in our economy is a residual, is what is reflected for. I know it forecasts the future, but in a sense, it's a residual. The stock market does not drive the economy. The fact that the stock market is up, it does not mean that you are going to go on a vacation. You will go on a vacation if you've made enough money in a certain year, which means the financial health of your household balance sheet, the balance sheet of the company that's paying you a paycheck, are all straightened up and are in a healthy position. So the market is just going to be a residual of what we think the economy is going to do. So now if you ask me, the economy has done well for the last 2 years. Inflation has been getting into control. Do we expect the economy to do well also in year 3? In that sense, yes, I would stick my neck out and tell you there's a good probability that the economy is going to be doing well next year. I don't know about the market. I really do not know about the market.
Give me the 20%.
I'm gonna go 70% chance that the stock market is better than cash next year. How about that, Rob?
Which
sounds
is
good.
what it is always.
Yeah, there's my answer.
Did you know the average up year in a market? So in the calendar years where the stock market is up, the average is 21%. That is up. That is the long-term average.
Wait, say that again, Jake.
In the up years, so when the market goes up, the average increase is 21%. That's
Wow.
the average things there.
That's
the
crazy.
average down year is negative 13 is the average down. So like I know we always talk about these like 8 to 11% average long-term returns, but in reality, like the actual calendar years fluctuate, I think, more than we give it credit for. Like 20% years happen way more often than we think, and negative 15% years
Negative
happen
double-digit
way more
years.
often than we think. You're actually like more likely to get more of the double-digit extremes than you are of the single-digit returns.
That's interesting. That is interesting. Yeah. Hey, this was awesome, guys. I just got a little ticker come across my computer while we were talking from Forbes. This is a little bonus round. Starbucks workers start holiday strike. So sorry, Ryan Isaac. You're gonna it's gonna maybe hurt your ability to go to Starbucks this year or
I
this
also heard
Christmas season.
Park City ski lift employees are planning to strike too right before Christmas.
Wait, again? I thought this was it Park City last year, or there was another resort. I can't remember.
No,
There was another
like,
strike
shoot.
somewhere last year.
Yeah.
My gosh. Okay. Maybe should we strike? Should Dentist Advisors strike?
Matt, I know we're at the end of the podcast here. If people are still listening, admit it. What are we at? 44, 45, something like that. I want you to be on the record of, I'm curious on just, we're about to enter the playoffs in the NFL. Give me your Eagles. I mean, how confident are you're going to the Super Bowl?
Eagles are winning it this year.
They are.
I'm saying it. They're winning it.
Lions have injuries.
Fairly confident. Lions have injuries. I think the Bills are going to beat the Chiefs in the AFC title game. I think it's going to be Eagles-Bills, and I think the Eagles pull it out. They have the formula to win it this year. They've got the number one run offense in the league. They can shorten games better than anybody in the league. They've got the best defense in the league. They can beat you in multiple ways. I just don't see a team out there that's as versatile as them. So I'm also a huge Eagles fan. But I will say this. Last year, they were 10-1. And I literally told my friends, and I have a couple clients who are Eagles fans, and we chatted about it. I said, this team is awful. They will not win a playoff game this year. They are terrible at 10-1. And they went on that horrible run. Yeah. They were terrible. This year, I'm like, this team looks like the best team in the NFL. And I think they're going to be tough to beat. So
I wanted that on the record. So as people are listening to this in a couple of weeks from now,
as they lose in round one, I hope not. I'm pretty confident they have the team to beat it. So to win it. So all right, Rabih, do you want to Jake? Do you want to give a prediction since you called me out?
Okay. Here's my NFLs on the topic. I actually think that just because we hate the Chiefs and that we are looking for any reason to we're justifying all these games that they're really close and we want them to lose. I think the Chiefs are going to be in the Super Bowl would be my prediction.
Yeah.
That's not a hot take, but it feels hot right now because everyone's like, the Bills are amazing and Josh Allen's great and the Chiefs barely win all these games. They're so lucky. I have a sneaking feeling that they're kind of sandbagging some of these games.
They could be. I think you're right.
They don't care about me. And they're just like, once we get to the playoffs, we'll win.
And I have a hard time ever betting against Patrick Mahomes, obviously. I actually don't hate the Chiefs. I really don't. I love Andy Reid, ton of respect for him. I don't hate the Chiefs at all, but I'm with you. I would never bet against them in a tight playoff game, especially Mahomes, and the fact that the Chiefs do get about every call in the NFL. But I digress. Don't get us going. As we finish the show, we just talk.
This is for the people who dedicated. They were here the whole time. They're now,
your gift.
Our last minute. Yeah,
us talking football. So is your prediction the Chiefs to win it?
No, I think they're going to make it. I think the NFC is probably better than the AFC this year. I mean, there's a lot of good teams. I think Detroit's still good. I think the Eagles are good. I think the Vikings are good, and the Packers. I think a lot of good teams.
Don't sleep on the Vikings. Don't sleep on the Vikings. They're great.
So I don't know. I would just say I would guess Chiefs Eagles Super Bowl. That'd be my Super Bowl, and whoever wins it from there, who knows?
So the Eagles. Okay, cool.
Yeah.
Okay, this is awesome. Rabih, you want to jump in? You want to throw your hat in the ring and any of this?
For the people who do not watch football like me, Merry Christmas.
Oh, there you go.
Beautiful.
I like this. Merry Christmas. Okay, this is awesome. Everyone, thank you so much for listening to Jake's Point. If you've gotten to this point, thank you so much for listening. We really appreciate it. This is our favorite part of our job. It really is. So we love doing this. Appreciate everyone listening and supporting us. We have coming up as we finish up the year, going into 2025. second annual Dentist Money Summit. We would love to have you out, meet your advisor, meet the great Rabih. Full new slate of speakers this year. It's going to be incredible. Theme is planned for the present. It's going to be bigger this year. We already have way more people signed up than we did this time last year. So it's definitely going to be a bigger event. We'd love to have you out. Check out dentistmoneysummit.com. If you want to talk to us, we would love to talk to you, hear your story, see how we can help. Dentistadvisors.com. Click on the book free consultation button. Until next week, Merry Christmas, everyone. That was our 2 cents. Have a good one. Bye-bye.